Hello, everybody. Thank you for joining us for today's webinar. Hello, Jim. Good morning.
Hello, hello. So anyhow, as we always say, we do these in order to draw attention to the educational programs that we have. The next program starts, when's the intensive, Jim?
It starts on October 4th and runs through November 2nd, I believe it is. Hold on. Well, if, do you want me to show the screen or are you?
No, that's
We'll
okay.
do that
We come back to
afterwards. Yeah.
but do remember that there is a prerequisite to the intensive. The prerequisite is that you have to have been to a previous intensive or completed the foundational e-course. We get numerous questions about people wanting to bypass the foundational e-course because they've used market profile in the past, but more than likely they haven't used it the way we do. The next thing I want to talk about this morning is this always confusion. My profiles are in two tick increments. Now, historically, what I've said is, you know, I'm in 2 tick increments above 20 and single ticks below 20 on the
Sorry,
VIX.
when Jim says 20, he means the VIX for volatility. Okay, just so we don't confuse folks.
I was just going to explain that. And the VIX is, you know, extremely low, but I remain in 2 ticks. And the reason, it's a personal reason. First of all, I have another monitor. I have the other monitor on my right, and that is in single ticks. The monitor we're looking at is in double ticks. And the reason that I keep the double ticks is a personal reason that I handle the volatility better. The single ticks seems to get me a little bit more emotional, and the keeping it in the double ticks is just keeps me calmer. So that's a personal choice. The most difficult thing currently is that I see absolutely no indication of longer term money in the market. The yesterday, and I'm going to go to yesterday for a second, and I'm going to split out yesterday. You see the late liquidation. What this was the reason that happened. This was all retail traders. All retail traders, you know, I mean, you say all, there's always going to be something, but predominantly retail traders. And as if you've been with us before, you've heard me say that so many retail traders are undercapitalized and they cannot take trades home long. Either they don't want to, or in most cases, their clearing firm won't allow them because they're undercapitalized. So what you get, and they panic, they just keep greed trying to get this last tick out of this thing all day long. And if you look at this thing, 1, 2, basically 3.5 hours, it went nowhere. The risk of staying long is huge, but traders do it trying to get that last tick. And of course, then when it comes close to the close, they're forced to liquidate. And when you have to liquidate that late in the day, there's no one going to buy it from you. And this gives you this tremendous liquidation. And of course, then the buyers, there were some buyers down there that took advantage of this. And of course, you see where we are today. But understand the difficulty in this and understand retail traders, just sometimes they don't appreciate the risk. They're so trying to get that last tick out of it. And, you know, FOMO sets in that makes it very, very risky. Now, we've got the same thing going on overnight. I'm going to split this out again. And the pullback in J period here was, you know, it went a tick or two below half back, but basically retail traders were sitting there buying this at half back. Okay. I mean, so again, it's very weak trading money in here. Now, the next thing I want to, let me collapse this. I'm sorry. Okay, the next thing, so we call carrying information forward. We have a multi-day balance in here. The top of the balance is the gap. On the 11th, the market comes up and taps the high of the 6th and also the gap. Right at this point in time, this is an alert that this is not a good high. It's a weak high. When it happens like that, it's mechanical sellers trading, selling at an exact level, or as we like to say, it's an anchor. An anchor is it's a psychological term that traders just decide that's of value. And it's a heuristic, but it's a rule of thumb that they do, but it really is nonsensical, but that's what they do. But the information this conveys to me is be very careful on the downside, because when you see this selling, this is not good selling. So you had no excess up here when you put these together. The following day, you had no excess. So this was a questionable, this whole area was questionable all the way through, as is the lower end of the profile. The lower end of the profile, we have non-excess low here, a non-excess low here, and another non-excess low here. This is also indicative. We have it on both the upper end and the lower end of the profile. This is indicative of a market that is being almost totally traded by the shortest of short-term traders. What I think is going on here is the institutional money, the larger money, really doesn't know what to do. They are just sitting on their hands. What they ideally, from everything I can ascertain, what they ideally would like to see is, a 10 or 15% break in the market so they could come in and buy. They're not getting that. And so they're not active in the market. So mostly it's short-term traders. This makes a very dangerous situation. So here we are now with about 20 minutes till we come in this morning. Overnight inventory is 100% long. Here's the settle, and we mark it from the settle. It's long. The last pullback, the last pullback actually was exactly at half back. I'm going to split this out again. I gave you a wrong answer before, but I just understand why. I said it went a little bit below half back. No, it didn't. It was exactly at half back. What happened is the range extension here changed half back, pulled it up. So this J period low was exactly at half back or within a tick. That is another indication that it's weak hands, short-term trading money buying. Now, as a short-term trader, and most of our clientele is, if you understand what other traders are doing, what your competition is doing, you can buy here. If you don't understand that this either works or it doesn't work, and you're either in or out, it either works or doesn't work. So if you know that this is what other traders are doing, then you can buy it. As soon as it gets up here, you don't want to fall in love with it. Now, sometimes it will continue, but from an odds standpoint, this is a very high odds position right now. Now, like I say, if two traders buy this, one trader buys it just because it's half back, and that's what they do. Another trader buys it knowing other traders will buy it there, but understanding these are weaker hands traders. Take what the market gives you, but don't stick around and don't fall in love with it. Okay, I'm going to collapse this. So we're going to open here in about 16, 17 minutes. Overnight inventory is 100% long. There's no excess here, and the market is aiming for the gap. That's what the market has in mind at this moment in time. Okay, I'm going to collapse this down again. Okay, so let me take a couple of questions and then we're going to do a commercial. Then we'll come back and talk more about markets. Okay, Jen, a couple of questions.
Okay, somebody's asking, so what did you think of, what happened with PPI?
One of the things that I tell people is do not read or look at PPI. Simply look at what the market does. So the market went ho-hum. The market went ho-hum yesterday and the market went ho-hum today. One of the worst things you can do as a short-term trader is take a look and think you're going to interpret PPI. Leave that to the market. Read what the market does, because it's, we don't listen to the talking suits. I don't listen to them because they've got a different time frame in mind than we do. And the best thing you can do is look at the market and see what the market does with it. The market said ho-hum. The market said ho-hum yesterday, and it said ho-hum today. Okay, next question.
Okay. Does Jim see an afternoon reference yesterday? Do you see any kind of pullback low?
No. No. The most important thing to me yesterday was that I was watching that market and it was just unbelievably slow. And it actually was a very rewarding afternoon, because I'm sitting there saying, we've talked about this. If you've ever been in our programs, we talk about this all the time. Is, late in the day, if the market's been slow like it was yesterday, and short-term traders, they just keep pushing, trying to get that last tick, and they're going to have to liquidate late in the day. And when they liquidate, all of a sudden, all the dickens break loose. This same thing, I've talked about this multiple times. This same thing happened continually on the floor of the exchange. When I was on the floor, you had the bigger traders in the crowd, and the bigger traders, and sometimes it was just the one top step trader, they would realize that all the short-term traders on the floor were leaning the wrong way. And if they were leaning the long way, let's say like yesterday, they were leaning the long way long, all of a sudden the large trader late in the afternoon, and if you're on the floor, you put your palms of your hands towards the crowds, that means you're selling. And all of a sudden they put their hands out and they sell. And they sell in size, and that just panics. That just panics the short-term traders, and it starts to feed on each other, and you got what you got yesterday afternoon. And you can get away with that when it's almost all weak hands traders. Next question.
Okay, 1 second, let me go back up here. Okay, could Jim point out a few examples in terms of anomalies? I don't understand it, especially visually.
No, don't worry about anomalies anymore. Anomalies, we went through a period of about a year and a half or so where we had all types of anomalies. We don't have them we don't have them anymore. So let's just, I've kind of retired that concept. That was years ago, and it was when we were having big runs up and big runs down, and the market was leaving, strange anomalies. But we don't have them anymore. Not
or better just to say you retired the concept because of other observations that,
Yeah, they just we went through a period where the market was very thin, but I haven't focused on that in years.
Okay. Okay, how do you deal with using 2 tick increments and excess? Does this not change, your excess minimum?
No, it doesn't for me. No, if I'm in 2 ticks, then my excess needs to be 2 ticks. Like I say, I have another machine now, another screen on my right, and I do have it in 1 ticks, in single ticks, just if I want to take a look at it. Okay.
Yeah, but definition wise, either way, you have to have 2 ticks for excess.
Yeah.
Okay.
And you don't want to be that exact. All right. Let's do a commercial. Jen, go ahead and take over, do a commercial, then come back and we'll take some more questions and update the market.
Okay, sure. 1 second. Let me take the screen back. Okay, can you see my screen?
Yes.
Okay, so if you go to jimdaltontrading.com, I just want to point out for anybody who's new, you go to courses at the top navigation, and you're going to see that the intensive is featured up at the top. And we also have the schedule right here that you can download or open up just to see, you know, what our topics are and what we'll be focused on, you know, for some of our special presentations. But if you scroll down, you'll also see that we currently have limited time bundles. The bundles are going to be available through September 22nd. So as you heard Jim say earlier, if you're wanting to join us for the intensive, we do have the prerequisite requirement of the foundation and application of the market profile e-course. So if you have not done that course yet, you can purchase a bundle and you'll still get a discount for purchasing more than one course. And so this would be the correct bundle with regards to that. Our foundation e-course is, was it a little over, was it 11 or 12 hours? And it covers much more than what our legacy products do. So a lot of times I get asked, well, what about field of vision or live market seminar if I've done that? I don't think I really need the foundation e-course. Can I join you for the intensive? The answer to that is that the foundation e-course covers more than what is covered in those legacy courses. And, you know, legacy courses meaning that those are older. I would say also that the foundation e-course helps you on your learning curve because of the way that it's taught and organized in terms of the information as well. So if you have any questions, by all means, our email is down here at the bottom of our website, dalton@jimdaltontrading.com, or you can give us a call at 409-422-7250. And like I said, the bundles that we have that are discounted will be available through September 22nd. Okay, so let me give you the screen back, Jim. There you go.
Okay. And let me make one comment. Historically, we've always said that successful trading is a combination of market understanding and self-understanding plus your strategy. Historically, we have leaned more on market understanding than self-understanding. This upcoming intensive is going to be tilted more towards the self-understanding. Matter of fact, it's going to start off with a large discussion, a book review, and a large discussion of intuition, how you build and how you hone intuition. So this intensive will be quite a bit different than some of the ones in the past, simply because we're shifting the focus more to the self-understanding portion. Okay, couple market questions.
Okay. Would you consider the weak highs as repaired or not because it happened overnight right now?
That question comes up all the time. No, trading overnight does not repair them. Now, if we gap higher when we open, then they are repaired. Okay.
Oh, and something that I forgot to mention about the intensive actually, and I'm reminded because somebody asked this question. From what I understood from your last webinar, this particular intensive in October will have more psychological discussions that traders face. Is this correct?
That's what I just got done saying. That's what I just said. The self-understanding portion of it, yes.
Right. And you'll notice also that the presentations are updated, or we have some newer presentations, as well as Jim wants to hit it early up front with regards to the psychological factor. So we're doing our book reviews, 2 book reviews early on, so that we can discuss that and then interweave that hopefully throughout the intensive. Okay, does yesterday's profile have a P formation with value yesterday being unchanged or overlapping to lower?
Yes, it does.
Okay.
But remember, overall, you had a 6-day balance. You had no meaningful excess at the high. So many times people get too narrowly focused just on yesterday's profile. Oh, it's a P shape and values overlapping to lower. And that's right. But when I do my preparation at night. As I've said so often, I start from the bigger time frame up. I look at the monthly bar, the weekly bar, the daily bar, then I come down to the profile. So when I come down, I say, okay, I've got a 6-day balance. There's 1, 2, 3, 4, 5, 6, 6-day balance. And I've got a gap on the upper. I have no excess on the upper end. I have no meaningful excess on the lower end. So I'm in there, and as I wrote, I think I did a report there's 4 people that I talk with every day. And I just said, I came into today totally neutral on the market. Okay, what else?
Okay. You often mention signs of weaker hands trader in the market and how to identify them, but do you identify stronger hands traders?
Well, you do it by a partial elimination. When you don't have the indications of weak hands traders, then the odds are much better that you have stronger hands traders in the market. So it's a process of elimination. Yesterday, for example, when you watched yesterday and it's just, goes to these exacting levels constantly, that's just a sign of weak hands traders in there. So when you don't see the market going to these constant, mechanical references, then that's an indication that you probably have some other participation, and that participation can be all over the place. I mean, it can be CTAs, and CTAs a lot of them act a little different than do hedge funds and do longer term money. But basically, when it's yesterday was just unbelievably slow, mechanical references, that's usually a sign of very short term traders. Okay.
Okay. Do you evaluate volume profile and market profile or separately or concurrently?
I don't use volume profile, although I am adding 2 of the VWAPs in the next seminar. As I've said so many times, historically, the weighted averages, volume averages, were indications that are used by institutions. And it does give you some idea of institutional money in the market. But the volume profile in and of itself, I don't use, although I am mixing more with the 2 other indicators. Okay, what else?
Okay, when you get a contract change, do you have the previous reference points, like for example, singles, POC, the settle from previous days? They're asking like basically how do you
Remember,
handle that for the references?
the December contract's been trading for some time. So you're looking at the December contract here, and I've just, I've had the December up, and I'm using the references off of December trading. I don't mess around with the roll or anything else. It just gets too confusing.
Right. So generally speaking, if the contract rollover just happened, depending on, what Jim is doing, if he's in a trade, he may still have, the prior contract because it's still trading. But once it's beyond a few days or whatever, usually he's on the new contract then.
Okay.
I know that sounds a little bit confusing, but that's how that is. Yeah, because another question is, how does Jim trade rollover, or does he? Because for me, it doesn't make sense for a couple of days when the rollover happens.
No, like I say, I just go to December. When it starts to get, because look, December's been trading for this December contract. It's been trading for some period of time, and there's been, there's been.
No, rollover happened on Monday, Jim. Rollover happened on Monday. So, if depending on what's happening or, the volume trading, Jim, if he's got some trades on, he might still be in the prior contract, but
If I have
otherwise,
but I've had the
yeah, if he's
December
got
up.
the option.
There's been enough activity in the December contract that I've had that up for some period of time. I may switch
Right,
and go look at the current contract. Okay.
right. Okay. Um, Given the size of this gap up, where do you put the probability of large liquidation at the open? Happy
I
to
have
help.
no, I don't have any probability of, I just look the market and see what the market does. In here, the overnight inventory is 100% long. The gap was not filled. They got the stops. The market went up. There were some stops up here. They got some of those. The odds are always very high that you're going to get a counter auction relative to overnight inventory. They're about 70% overall. Additionally, remember this last rally came from exactly half back. Now that changed when you got the range extension, but this is not strong from what I can see. But again, you had no real excess on the high, and you still don't have any excess up here. Okay, final question. Jen, are you there?
Okay. Yes. So with regards to, the balance, somebody mentioned that they see that it's between the 50 and the 100-day SMA. Do you consider that in itself another form of balance?
No. I just look at the profiles and, I just see what we're dealing with now. You looked above, well, we'll see. We've overnight, we looked above the 6-day balance, but this is a go, no go level. Do you look above the balance and extend to the upside? Or do you look at above the balance or at the top of the balance and fail and begin a rotation lower? So this is the key level up here is seeing what happens right here at the high of the 6-day balance. This is what I call a go, no go level. The gap is the gap is the main upside reference for this morning. All right, let me say thank you very much. Have a great trading day, and I hope you join us for one of our programs. Bye now.
Thank you, everybody. See you at the next one. And if you have any questions, don't hesitate to contact us at the email at the bottom of our website or the phone number there. I'd be happy to speak with you. Thank you.